Welcome to Introduction to Stocks, brought to you by Kanjo.com. Stocks are a very popular and exciting investment, but there's also a lot to know, so this video goes through some of the fundamentals. Let's start by understanding what is a stock. A stock is basically an equity stake in the company. When you buy a share of stock, you are buying a share of the difference between the assets, the things the company owns, and the liabilities, the things the company owes to creditors. So that's an important way to look at stock investments. The other thing that you should think about is that you are buying a share of the future profits of the company. Stock prices are very strongly correlated to corporate profitability. So if a company is making a lot of money and that amount of money they're making is growing every single year, stock prices tend to rise. If the company is losing money or their profits are on the decline, stock prices tend to go down as well. So that's another relationship that is crucial to investing. Let's now move on to the difference between public companies and private companies. A public company has its stock traded on exchanges throughout the world. So for example, Citigroup, General Electric, these are large publicly traded companies. Anyone can invest. You don't have to be an employee. You don't have to be a current shareholder. Pretty much anyone can go and buy or sell a share of Citigroup or GE anytime the exchanges are open. Private companies operate differently. You can only invest through a private transaction. They still issue shares. Those shares still entitle you to a percentage of the future profits, but instead of being traded on public exchanges, these transactions are done on a private basis. So this is the fundamental difference between public companies and private companies. There are a whole lot of other legal differences as well, but this is the important difference to understand conceptually. Finally, let's move on to stock valuation. Stock valuation is a very complex topic. It's more of an art than a science, really. It's very, very subjective. That's the first thing you should know about it. A lot of people think that it's a scientific thing and all stocks are priced perfectly. That's not true at all. There are a whole lot of qualitative variables that go into valuation. Examples of these variables include things like management. The CEO. Is the CEO doing a good job? Is he a good CEO? Product choices. Is this a good product for the company to be in? And brand. Is this brand something that the consumers will respect and pay a premium for? Different people will have different opinions on these things, and that's why stock prices are so subjective. This makes stocks risky and hard to value. Because people have all different opinions on how things are going to work out, stocks are very, very hard to price. And as a result, when you make a stock investment, you are making a bet. It's not a sure thing. There is always the high possibility you could lose money, and any number of variables can drive the stock price up or down. So it's important to remember that stocks are a speculative investment, and understand why they are speculative. It's because there are so many things going on within a company. So I hope this video has helped you understand the basics behind stocks. For similar videos on the topic, I recommend you check out my website, www.kanjo.com. Thanks for watching.